You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Bootcamp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. Most options trading platforms are commission-free, and there are some that don't charge per contract fees. Public.com goes a step further. When you trade options on Public, there are no commissions, no per-contract fees, and you get a rebate of up to 18 cents per contract traded. That means it costs less than $0 per transaction. In other words, instead of paying to place options trades, you literally earn money, and that money can add up fast. If you trade 1,000 option contracts on Public, you'll earn up to $180 in rebates. 10,000 contracts? Up to almost $1,200. It's pretty obvious why NerdWallet recently gave options trading on Public 5 out of 5 stars. Because Public really stands out for the cost of its options trades. Their words, not ours. If you want to start paying less than $0 to trade options, check out Public.com and get a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. U.S. members only. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody. That music means we are back. It is Wednesday. It is 1 p.m. Central. It is, of course, Education Wednesday because it is time once again for Options Boot Camp, the premier options educational program. We've certainly been doing it the longest, if nothing else, out there, at least on the podcast side. My name, of course, is Mark Longo from the THE, optionsinsider.com. as well as from the network upon which all of you folks are binging. Remember, if you like what you hear, first off, you should be listening to the full network. Vol Views just did the advisor's option with our buddy Mr. Matt from Orats yesterday. Another fascinating one. The option block twice a week. This week in futures options, crypto rundown, all sorts of great stuff coming at you throughout the week on the network. So you got to get over there. Make sure wherever you're listening to Options Bootcamp, you should upgrade to the full network. You're going to get a lot of shows coming at you that will, I think, serve you well in your options trade. I've been doing this for 17 plus years now. I think we know a thing or two about options. People seem to like it. So head on over there. Make sure you upgrade to the full network. If you like it, a rating, a star, a comment does help new people continue to discover all this goodness we've been throwing at you for, again, over 17 years, over a decade on this program alone. And then, of course, if you want more in your lives, including you want to come back pretty much immediately after this show to pick the brains of some of the best and brightest minds in the world of options and derivatives, and head on over to the pro. Theoptionsinsider.com/pro is the place to go to learn more. We got Mr. Bill coming up, longtime options market maker and risk manager out there, did it for decades, as well as now very deep in the crypto space. So that intersection of options and crypto you don't see too often. So it's always fascinating to pick his brain, and you folks will do just that in a little bit coming up on the pro. So check it out if you are intrigued, theoptionsinsider.com/pro. Of course, you join up after the fact. It's all there waiting for you as well. And you know what else is waiting for us is the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring, what the cool kids call to Mr. P, welcome back to the show, sir. How go things in the options mecca known as Frankfurt?
It is going just pretty darn swell, Mark. Glad to be here. Got an exciting show planned, I hear.
We do. The listeners dictate, Mr. Dan, and we follow as it is time for the mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, let's get to it, listeners. Time for the mail call. By the way, I mentioned you guys can leave, and gals, of course, you're all welcome to leave reviews out there. This week's 5-star review came from Delicious, but with a Z, so apparently it's delicious. Delicious. Just says, learn and earn, listen and repeat. You know, a man or perhaps a lady of few words, Mr. Dan, but you know what? We appreciate brevity, and we appreciate everyone who takes the time to rate and review us, don't we, Mr. Dan?
Absolutely. Yeah, we love it, man.
Speaking of the folks, Dan, they have spoken, and never let it be said that we don't listen to the folks here on the show. Because, man, did they respond, Dan, to our conversation about zero-sum options last week. You know, you never know. You never know what is going to resonate with people. I said this, we did a couple of years ago, we did box spreads. I think it was on this show. And box spreads are probably the most boring thing I could think of, which is probably why we hadn't really talked about them until that moment. You know, it's an interest rate play. Who gets worked up about that, right? And that just set off the floodgates for all sorts of comments and questions and insights into box spreads. And so you never know what is going to resonate. So last week, when we did what I considered kind of a very straightforward episode, our options, a zero-sum game, yay or nay, you know, I'm pretty clear that it's no. And yet, Dan, it opened the floodgates with the masses out here. First off, we did do a poll to coincide with the show last week of the audience. We asked you folks, are options a zero-sum game? And Dan, I don't know if you watched it throughout the week, but it was fascinating to watch the results ebb and flow. First, it was no overwhelmingly. I think a lot of the pros in our audience dived in there early. And then, you know, over time, it evolved. And next thing you know, yes was winning for a while, 60-odd%. And then it finally swung back in the other direction. But it was still pretty close, Dan. It ended up being 57.4% only saying no, and 42.6% saying yes. So that surprised me. Did that surprise you, Mr. Dan?
Yeah. I mean, to me, there's like a very clear right answer. So yeah, I don't know, man. Yeah. Yes, it surprised me very much so.
Yes. So, clearly we need to revisit this topic. Of course, it also unleashed a flood of feedback from you folks out there on both sides of the fence. But you know what, Dan, never let it be said that they jokingly refer to me on some of the other shows on the network as the benevolent dictator. But never let it be said that I am dictatorial when it comes to the viewpoints of things on this network. I am open-minded. I am willing to listen to other people's conversations and arguments, provided, of course, that they are proper and pleasant, let's say, and informational. There were some people, Dan, who got a little hot about zero-sum options, which surprises me. We don't need any of that. No one needs to question Dan's manhood. I do enough of that here on the show. We don't need that from the listeners out there. 99.9% of you were very respectful. We love you all out there. A few of you got a little heated out there. And again, keep it respectful at the end of the day, even the seemingly contentious topics. But Dan, I actually opened it up to some of our other hosts on the networks. I thought, you know, maybe there's more to be said about this. Maybe there are other viewpoints to bring in. So we discussed it on Options Boot Camp after this show. On the Option Block last week with our buddy, the Flow Master from SIBO, and Uncle Mike, who's been on the show a few times. We did it again on Volatility Views with our guests there as well. Even yesterday, opened it up to our buddy, Mr. Matt Amberson, to give his thoughts on all things, our options, a zero-sum game at the end of the day. Maybe I'll have our producers cut those in at the end of the show so you folks can hear them in detail. But at the end of the day, they all pretty much came down on the same front that we were, Dan, that they are not a zero-sum game. And you know what? I'll read some of these conversations we have here. Let's start with Vivek. He makes an interesting point. And again, we love all of you out there. Take the time to send in. A lot of you sent in epic treatises on this topic. Again, very surprising, but we love you folks are responding to this. Vivek writes in to say, hello, Mark and Dan. I just listened to the zero-sum debate, and I wanted to put forth my thoughts on and my arguments on this topic. He goes into the stock side first, Dan, which, by the way, we had the stock poll last week as well. We asked our folks, it was just a flash poll during the show. We said our stock's a zero-sum game. It was pretty much 100% the entire way. I think you may have done some skullduggery with some of your folks at the end, Dan, because right at the last minute, it dropped to 2/3 for yes and 1/3 for no. So somehow 1/3 of you snuck in there and turned it to the dark side. But it still was pretty much predominantly overwhelming our stocks and the Delta One, a zero-sum game. Most of you pretty much agree that it is a zero-sum game. With the exception of Vivek. Vivek says, first off, why stocks are not, in all caps, a zero-sum game. He says, I'm with Dan on this one. If the company does well, wealth is being made. Let's say you buy a stock from someone, the seller's cost basis could have been lower than what he's selling to you at. And if the company is doing well, your net wealth rises as well. There is a positive net change in wealth for both the seller and the buyer. It is not zero-sum. Dan, that sounds along the lines of what you were trying to lay down on the show last week. I will be honest, I listened to your comments a couple of times. I still wasn't picking up what you were putting down about the stock side. So if you want to add on to anything Vivek is saying here, he clearly agrees with you. Maybe expand on your reasoning on, we'll go stocks first, why stocks are are not, I'm even getting backwards with this, are not a zero-sum game, sir. Have at it.
Yeah, okay. So, Mark, think about it this way, okay? So you buy 1,000 shares of Apple today, right? You buy it right on the close. You put it in like a market on close order. So you get filled at 168. Okay. So that you just shelled out, what does that come out to? $168,000, I guess, right? Okay. So you bought that on the close. Now, tomorrow morning, Apple opens $2 higher. Okay. So you just made 2 times 1,000, right? 100 shares.
I'm sitting pretty. I'm rolling in it.
Yeah. So you just made $2,000. Who lost money?
Be the person on the other side of that trade, sir, who is now shorted, if they are shorted.
They're not shorted. The person who sold those shares to you was long it.
So you're saying it was a closing transaction for them.
Right.
So in that scenario, if it's a closing transaction, then there's really only one side left, right? The other side is done. I only consider that to be a one-player game at that point. When I think of the zero-sum debate, I think of 2 players. Someone's shorting and someone's going long at the same time, right? Because that's really the zero-sum, the push, the pull, right? It's the pie that we all want to eat from. And if I cut a bigger piece, that means there's less pie for you, Dan. And that's what I think of when I think of this kind of zero-sum and the Delta One side there. So if you're closing, I could see an argument. Someone, I think it was on our Twifo show, I think it might have been Scott from Prosper said also, because we talked about Delta One being zero-sum, that would include futures. And he made the argument that on the future side, they could short it and then you could be long it and they could not close it out technically. So they could not have realized the loss on the short side and you could be long and making money and then you sell it out and you close it and they could wait and it comes back. So there are some nuances I could see you could add to this. That's the conversation we need to have for this whole thing, Dan, which is effectively maybe we need to set some ground rules for this conversation. Some 6 degrees of Kevin Bacon, if you will, for the zero-sum world, because a lot of the feedback we got, Dan, was, well, you guys said options are not a zero-sum game because market makers hedge. But a lot of people pointed out, what about the guy who sold the deltas to you, right? What about the specialists there? If you include them, if you expand the ecosystem to include the source of the deltas to the market makers, then there is a loser. So therefore, it is zero-sum. And it sounds like your discussion for the stock side is a little bit different. Well, before I keep going for that, let me finish what Vivek has to say, because he also has a conversation about options as well. Then I'll get to our moving the goalpost discussion. He says, Vivek says, why options are, in all caps, a zero sum. I get that at a per transaction level, both the trader and the market maker can make money. The trader makes money due to a move in the underlying. The market maker makes money from the bid-ask spread. Well, that's one of the ways they can make money, Vivek. There's other ways they can make money on it. But yes, the bid-ask spread, in an ideal world, they buy on the bid and they sell on the offer. In reality, that doesn't really happen very often. He goes on to say, however, from a mathematical standpoint, if the market is efficient, when probabilities play out over a large number of trades, you as a trader are not making any money. Example, if you keep selling options at a 70% probability of success, you make $30 7 times and lose $70 3 times over the course of 10 trades. Sure, 10 trades is small, but if you let the probabilities play out over a big enough sample size, you make net zero. And if you include slippage and commissions, you as the trader actually end up losing long term. You're betting against the casino. The only way to make money is if you have an edge, but if you do have an edge and you're not an insider, isn't the edge public knowledge? Wouldn't that be priced into the stock or the option in that case? Thanks, Vivek. So he makes a different point about why options are zero sum, Dan. He looks at it more from the aggregate perspective, saying in a large volume of trades, the end trader, maybe without an edge, won't be making any money. Therefore, options are zero sum. That's not really the way I was viewing it. I was viewing it on the more single transaction basis. But Dan, what do you have to say here for Vivek, who points out the aggregate profitability of options trading as a reason why they are zero sum?
I'm not sure I'm with this argument. I don't think that. I personally don't think that that's the way to look at it, because I think you're measuring something different if you're looking at it from the edge standpoint. I mean, I agree with what Vivek says about edge here, if I'm picking up what he's laying down. But I feel like that's a different discussion than it being a zero-sum game.
Yeah, I don't really agree with Vivek on that point either. I think he's kind of talking about a different thing. The lack of edge over time in aggregate options trading has nothing to do with the fact, or the lack of a fact, if you don't agree, that it is or it is not a zero-sum game on a pure transactional basis at the end of the day. All right, let's keep going. Some other people commenting in here. We got a lot of people writing in. This, our producers highlighted this one. I will say, first off, the handle is bleeds, so I guess we should probably expect a little bit of vitriol. The handle like bleeds. He writes in and says, yes, options are a zero-sum game. Remember, let's keep it civil, folks. I'll leave off some of the latter portion of this email that is questioning Dan's manhood. But the confusion arises, he says, because you, I think he's talking about me here, you deceptively change the rules after asking the question. Dan correctly states that options alone are zero-sum. The problem is you then state that because the market maker does deltas, that both parties can win. Sure, but this isn't fair because now you're ignoring, again, this is what I'm talking about, Dan, expanding the goalpost, moving the goalpost a bit, because now you're ignoring the third guy who did the deltas against the market maker. If we include this hidden guy that you refuse to acknowledge the existence of, again, people getting hot about zero-sum options. It's crazy. We are back to zero-sum. He goes on to say, you're not operating in a closed system, the same two people. He questions Dan's manhood, so on and so forth. Again, let's keep the vitriol to a minimum, folks. We're all trying to help each other here at the end of the day. I get it. People get excited about things. No need to take it to extremes. But this is one example of many people, Dan, who kind of wrote in with this same comment. What about the person who sold the deltas or bought the deltas from the market maker? If you include them, then it is indeed a zero-sum game. My thoughts on that, Dan, are, like I said, I think we need to establish some ground rules, some 6 degrees of Kevin Bacon separation here for this. What I was talking about is real-world practical options trading, how this stuff really goes on and how it goes up on a trade-by-trade basis. Customer comes in, they sell a call that they think is, overpriced, whatever the case may be. Market maker buys that call from them. turns around and immediately sells stock against it to hedge away their delta risk. Bam, done. Close the goalposts there. That is the transaction that I am looking at. That is, for all intents and purposes, the options trade that we are evaluating here. You can't ignore the delta component because that is integral to how this market functions. If market makers were not allowed to hedge off their delta risk, there would be no options market. They'd be choking on deltas for days. They would have gone out of business decades ago. So to ignore that and say that's not part of the conversation, only look at the net options contract, or the customer sells it and the market maker buys it, therefore the customer wins and the market maker loses, or vice versa, based solely on the performance of the options, is again ignoring the way options actually trade in real life. No liquidity provider is out there just doing naked options unless they can buy on the bid and sell on the offer back and forth, which again, as you pointed out to Vivek, very rarely happens. So no, they are hedging away that risk. They are mixing it in with a basket of other things and hoping to make money again in the aggregate. But to ignore that component, to say that is not part of the options trade we're analyzing, is foolish. This is practical, real world stuff here. We're talking about an options boot camp, not theory, not any sort of, impractical P&L graph on an options educational chart. This is how options actually trade in the real world. And the other side of that, of course, is the notion that now, okay, let's trace it to the person who has the deltas. I think that's getting beyond the scope of what we're talking about here. What you see in a lot of the broad financial media, the arguments we used to hear all the time back when we were on the floor, and we still hear it today in some lesser informed outlets, is that, options are a zero-sum game. So for every side of the trade, one side has to win, the other side has to lose. Again, demonstrably false because of the hedging component, which also means, of course, they're not a zero-sum thing. But also this notion you hear all the time that for every buyer, there's a seller and vice versa. Technically true, but again, practically not at all the case, because remember, Dan and I were out there. I'll give myself as an example. When I went out to Intel after leaving SPX, do you think I woke up every morning and said, well, I really want to spend my day buying every freaking out of the money call that every fund and every customer wanted to sell to me on a regular basis, so it's choking on out of the money premium, and at the same time selling every out of the money put I can get my hands on, because all customers wanted to do was buy puts out there. Just rinse and repeat until the skew got just twisted and jacked beyond all recognition, and we were scrambling to buy back said puts at 3x the vol that we sold them at the beginning of the month, or things like that. No, that was not the plan. That's just the way the order flow unfolded out there. So the notion that there's some opposite economic incentive to you on the other side of every options trade, also false. Dan, what are your thoughts on this notion that we need to move the goalposts a bit and expand the conversation to include the deltas and the person who originated the deltas? Are you yay or nay on that? And how does that impact your overall thoughts on the options zero-sum game thing?
It's a good point to have. I'm getting that echo again. It's a good point. Darn it! It's a good point to have brought up, and that gives me a chance to talk about why it's so important to talk about stocks not being a zero-sum game, because that's all part of the options question, the way I see it. So you know me, Mark, when you're talking, I just stop paying attention. So I started Googling some things.
And also drinking heavily.
That's only on Fridays at noon. So, I found an article here on NASDAQ.com. I think it's written a couple years ago, but it doesn't really matter. That says the short interest of the Russell 3000 or S&P 500. I don't know. I just kind of skimmed it because I did want to kind of half pay attention to what you're saying. Is about 3 to 4%, meaning overall across the broad markets, the short interest, 3 or 4%, let's just say 4% of stocks are shorted at any given time. Okay. So what you were talking about with stocks seldom comes into play. Somebody buying a stock from somebody shorting a stock comes into play 1 out of every 25 trades, basically. That's not the norm. The norm is that you're buying from someone who was long it. You know, it's kind of like if you go to the grocery store and buy a potato, like who got value there and who lost value there? Nobody. You got this thing to you know, they're going to make for dinner that provides sustenance. The grocery store got the money. It was just an even transaction. So like with stocks, 96% of the time, you're just simply buying from someone who's just passing that hot potato on to you. And wealth, and consequently, like wealth does get created there. And so, because like you pointed out, Mark, in the options world, the only way for it to function is for market makers to hedge. Like that is that is the mechanics of how the entire options market works. And if market makers, if it didn't work that way, it couldn't work any other way. The market would just fall apart if market makers weren't delta hedging every trade. So that's why we have to include stock in the options conversation, but there is no relevant third man. Because the person who the market makers are buying those deltas from, they're just passing it along. They're just saying, hey, here's this thing that I have, give me money and now you have it. They're not losing money because they sold it to them. So to me, that's why these conversations need to go kind of hand in hand.
Do you agree with me that we should probably not, as they put it, the mysterious third man that we refuse to acknowledge exists, the Delta provider? You don't think we need to include them, and that we should cut the goalposts off at the options side, because that's what we're talking about here. At the end of the day, we can go crazy extending it, infinite permutations, and people did in some of these epic treatises that they sent in here. Dan, I'll let you have the final word, Dan, because, well, actually not the final word, because at the end of the show, I think I'm going to have our editors cut in some of the thoughts from a bunch of our other network hosts who were all very willing to chime in on this debate. Spoiler alert, most of them coming in, I think all of them actually coming in on the options are not a zero-sum game side, but you can hear it for yourselves, and you could send in your angry letters afterwards. Remember, let's keep it civil, folks, on this very contentious thing. But Dan, any final thoughts on this whole yay or nay options? Are they zero sum, yes or no?
No, I mean, I guess the only thought is that it's kind of fun to have conversations like this. Just being able to muse about really esoteric option stuff is such a dream for a big nerd like me. And apparently it's a dream for a lot of our audience, our listeners.
Yeah.
Who are jumping in.
They're loving it, apparently. So yeah, just to sum up, listeners, I say no, Dan says no. The majority of the people on our network say no. The majority of people in our audience say no. A handful of you wrote in, or a lot of you wrote in on various sides. A lot of you wrote in to kind of discuss the Delta side. I say kind of draw the lines at that. The Delta component, it's easy to see it as a separate thing, but it really is inextricable to the institutional side of the options trade that is being done. One would not exist without the other. So they are pretty much two sides of the same trade. You have to have the Delta side to do the options side. So include that, but then you have to cut it off at some point. You can't keep going on to the stock specialist and everything else like that. And also Dan's point that oftentimes those trades are closing for them, in which case that does change the zero sums debate on the stock side as well. Who knew that the stock side would become the most contentious one for us here on the show? But Dan, I got so excited with all this zero sum stuff, I forgot to play your theme music. So without further ado, sir, here we go.
And now, it's the moment you've been waiting for. It's time for the Market Taker Question of the Week.
All right, I lied. I really just wanted to hear Danger Zone again. That's pretty fun, even though it does get us probably banned from all of the YouTubes and everything else out there. Mr. Dan, do you have anything in store for myself and Mr. Loggins this week, sir?
Our future is a zero-sum game.
Oh, here we go. Let's open that whole door again. Let's just go right back into it. Round 3 now.
Geez, Louise. I'd actually have to think about the answer to that one. My question of the week is, I don't really, you know what? Actually, there is something that I was thinking of this morning that I'm going to make the question of the week, because it's kind of an interesting thing to think about. So I was a guest on a webinar this morning, and the whole purpose of the webinar was basically just for me to find trades. Somebody would throw out a symbol and say, hey, what do you think about this? And I'd talk about it. So one of the symbols that somebody threw out was VXX. And so I'm looking at VXX and I'm thinking, is there a trade here? And I found one. And what I did is I sold a put credit spread in VXX. I think it was here, let me tell you what it was. It was the 9 days to expiration, 13.5 put credit spread. So what's interesting to talk about that trade, that if I were to make that into a question of the week, I'd have to think of how somebody would phrase it. But what's interesting about that trade is that in a way, like on the surface, I'm doing the opposite of conventional wisdom. Conventional wisdom is you want to be buying puts because this thing goes down over time, is basically how people think about it, right? It goes, and what I'm doing here is I'm selling puts. It's a put spread, but I'm selling put premium. So am I doing something illogical here? And as far as illogical, like, I don't know if the trade will work out. I don't know if any of my trades will work out. I think it will, otherwise I wouldn't have put it on. But it's definitely not illogical for the surface apparent reason. And that's because the reason VXX goes down over time is because of what we call contango bleed. There's a few different ways to put it, I guess. And that's because the VIX futures, the term structure of them tends to be in contango. It tends to be higher the further out in time you go. And so that means when the VXX ETN, I think, right, rolls, they're always selling the low front expiration and buying the higher back expiration. So value is destroyed over time. But here's what's kind of interesting about this trade. The first 3 futures expirations that would be the futures that the VXX fund managers are going to roll from and to, they're all trading at the same price. There's no contango or backwardation for that matter. So as far as this screenshot in time, there actually is no contango bleed. So it's not really relevant. This fact that value is destroyed over time and VXX goes down over time, yes, but not today, Satan, because contango doesn't exist in those relevant expirations at the moment.
Yeah, we're looking people were just asking us the other day, we're getting juicy in the volscape. VIX futures actually closed backward this week for the first time in ages. So yeah, in that scenario, VXX, all these other products are talking about, UVIXs and everything else, they perform a little bit differently. They don't have that traditional bit of bleed going on out there. So intriguing. It's a brave man to sell puts in VXX, Mr. Dan, but intriguing stuff out there. Look, there you go. A little bit of VXX. It's like a little bit of dose of vol views here on the old OBC. Let's get out of here. Let's do a palate cleanser, listeners, away from all things zero sum. Let's go out to a straightforward question, a fun one from Nicholas. Nicholas, I don't want to butcher your last name. Zuitz. I'm going to guess that's what it is. I'm sure I butchered that. But thanks for writing in. He says, on Options Bootcamp 279, it was mentioned that they would quote, very rarely recommend a retail trader to trade a stupid. So under what rare circumstances would you recommend trading the stupid on a retail level? Yeah, I think as we said on that show, neither Dan nor I are fans of stupids. We don't really recommend them for any reason. I think what I was alluding to, I believe I was the one who said that. What I was alluding to there is really the only circumstance that we see stupids going up for, where I could see an argument for, and talking about the initial onset stupid, where you put them on at the beginning of the trade. That really is for large funds who maybe want to split their deltas or get a different type of execution than what is available on the listed stuff. They want to kind of go in between. So maybe they do 50% on one strike, 50% on the other, or maybe they do a ratio to get some sort of approximate delta exposure that they're looking for in a particular way, or maybe they want to get some sort of mid-strike type of positioning there. That's the only real use case I could see for that, and even then, I'm not a huge fan of that. What we did recommend on that show, this is kind of what I tend to refer to as the inertial stupid. Again, I don't ever like anyone setting out to do these. Just buy, let's say, Apple, you buy the 170 calls, and you decide, I'm going to buy the 180 calls too at the start of the trade. That's nonsense. But what can happen is, let's say you buy the Apple 170 calls, Apple explodes, and now in a few weeks' time, let's say it's trading 180. Now you're like, well, I like Apple. I like it even more now. Maybe something else has happened to change my outlook, make me even more bullish. I'm not going to go back and buy those 170s again because they're $10 in the money. That's ridiculous outlay for no reason. But I could see then coming in and buying more, let's say this time, of the 180s. So what have you done now? You've legged into what I have jokingly referred to as the inertial stupid. So you bought one, the trade went your way, you bought some more at a higher, or if it was a put, a lower strike price because the trade went your way. I could see that. I was trying to be charitable on that show, Nicholas. There really is no reason I could think of for a retail person to really want to put on a stupid from the outset. Dan, I know since that episode, you've had some time to mull it over. Have you come up with any reasons, any very rare circumstances where you say a retail trader should trade a stupid at the outset?
I mean, maybe if you don't like the guy you're talking to.
Yes, there we go.
Hey, there's an option strategy named after you. No, I don't know. It's been a few weeks since we had that conversation. I think at the time there was something that crept into my brain that I thought made sense, but I forgot since. Maybe as I think about it, I don't even think this makes sense, but like one thing that I will occasionally do, not too often, is do the classic textbook call buying as an investor thing, where I'm basically using a call to hedge against being out of the market for a particular stock. Like, I want to buy this stock, but I'm afraid it might go down. I want to buy it in my IRA's long-term holding, but I'm afraid it might go down. So I buy a call, and if the stock goes up, I just exercise it and keep the stock. If it goes down, then I did a smart thing. Arguably did a smart thing either way, potentially. So maybe if I don't know, maybe if you do that and you buy in at the money, but then also buying out of the money to save. I don't know. Yeah, I don't know. I'm grasping at straws. I find it to be a very indecisive strategy that doesn't really have much utility.
Yeah, that's my main gripe against it as well. It's just too indecisive. Pick your strike, right? Pick where you want to be and get all the position you want on that strike. Don't split it. Don't hedge your bets. I want a little bit of the 170s, and I'll take a sprinkling of the 180s too, just in case. Why are you doing that? There's no real reason. So, Nicholas, I think I was trying to be charitable in that episode. I didn't want to completely crush the dreams of anyone out there listening who loves themselves a little bit of stupid action. So I think I was trying to be charitable to leave a window open for some use case out there, but really in all practical senses and purposes out there, there really is no practical reason for a retail customer to trade a stupid. Again, the inertial one I could see, large funds doing splits across multiple strikes to try to get some sort of mid-strike execution or some approximate delta percentage. Maybe they just want a number of deltas. They don't care where they're getting them. I could see an argument for that maybe. But for the retail, there really isn't. So I didn't mean to lead you astray with my my little dollop of hope that I left. It's like Pandora's box. You have to leave a little bit of hope at the bottom after all the vitriol that we dumped all over Stupids on that episode. See, Dan, I try to be a nice guy, and I just lead to more confusion, sir. That's what I get. That's what I get for trying to be a nice guy here on this show. All right, Mr. Dan, if you want to disabuse Nicholas of his interest in Stupids or anyone else, where should they go? What should they do?
Yeah, make your way on over to markettaker.com. 2 T's in a row. Join free. You can chat with me or our other coaches in the community chat room we have, and we'd love to help out any way we can.
There you go. Check them out at markettaker.com. Don't forget the second T for Theta. And while you're checking things out, check out our new friends on the old network over there at Public. Again, people always complaining, man, there's no new options brokers. There's nothing new in the business. All the old brokers have been bought up. They're all gone, or they're changed, or they're different. Here you go. New players coming into the game, bringing the heat, bringing something a little bit different. I like that. I like a rebate. We haven't really seen that brought to the table before. So very intriguing. Kick the tires and light the fires. Check it out for yourselves over there at Public. If you like it, tell them you heard about it on us. Even if you don't like it, you can still tell them you like that you heard them on the old Options Bootcamp show. It's a long way to help supporting this show, listeners, so we can keep doing another decade plus of great free episodes for you folks out there. So if you like what you hear from this sponsor, any of the sponsors on the network, or you like the fact that they're just on the network at all, reach out to them, tell them, hey, heard you on the network, like what you're doing, keep it up. Again, that's what keeps these shows free in your inbox at the end of the day. That's going to do it for Options Bootcamp here. If you want a little more in your lives, head on over to the pro, theoptionsinsider.com/pro. I'll be back in 15 minutes exactly with our buddy Mr. Bill to talk all sorts of the intersection of options and volatility and crypto. How do they all come together? I guess we'll find out in a little bit when we tackle your questions. Back again tomorrow for, of course, our doubleheader on Thursday. First, we kick it off with the option block with our friends over there at SIBO and with the Flowmaster, everybody over there. Then, of course, after that, we'll come back for a little This Week in Futures Options. Our friends over there at CME. Our other Dan on the network, Mr. Dan Gramza, taking all sorts of topics down on the world of futures options. Back again on Friday for a little bit of vol views. We talked all things UVXY last week. You folks loved it. Who's going to be our special guest this week? I guess you got to tune in to find out. And then after that, one final time for the week, exclusively for our pro folks, we come back for a little bit of options oddities where we get into all sorts of trouble, into all sorts of fun trades out there. A little bit of options oddities. Check that out in the land of the pro. Then we're back again next week, all the way through to another Education Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
Check out public.com if you want to literally earn money to place options trades. There are no commissions or per contract fees. And Public gives you a rebate of up to 18 cents per contract traded. Discover why NerdWallet recently gave options trading on Public 5 out of 5 stars. And start paying less than $0 to trade options. Only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures and podcast description. U.S. members only. And now, it's time for the show that breaks down the options market from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block.
Are options a zero-sum game, yes or no? I will say right now, it is deeply divided. Yes was actually winning it right before showtime. Now we have swung 54.5% for no, 45.5% for yes. This to me is a very surprising result. So I want to go around the horn, get everyone's thoughts. Maybe there's a fun debate to be had here after all. Let's start with the unklest of Mikes, Mr. Uncle Mike Tusaw, sir. When I say to you this question, when I ask you, are options a zero-sum game, how do you answer and why?
I would say no, they're not. Just from a very simple standpoint that, let's say that I'm a covered call writer and I want to sell my covered call on NVIDIA. I sell you my covered call, NVIDIA gets called away. I make money, but NVIDIA goes higher than my covered call or my call is worth it initially. You make money because you bought the stock from me at a better level. So we both made money on that ultimately. Now, the option itself, you could argue is zero sum. I lost penny for penny what you made on the option itself. But because of the fact that we have other instruments and other things, it makes me feel like it's not a zero sum game.
Yeah, I mean, we live in the real world, right? In the real world, options have that hedging component to them that you don't really have in Delta One. So by definition, they're really not. I mean, you could both eat from the same pie and both have as much as you want and do well on it, as opposed to stock, where if I cut a bigger piece, you get a smaller piece, and a very different conversation. But who knows? Let's go around the horn. Maybe there's some debate to be had here. Let's go out to the greasiest of meatballs, Mr. Meatball, sir. What do you say when I ask you that question? Are options a zero-sum game? Yes or no, and why?
Well, it depends how many steps you want to take to get to zero sum. If you're just looking at, I buy a call option, market maker sells it, and then hedges, yeah, we can both win. But if you think about it, the market maker, when he hedged, had to buy the stock from somebody. And so if the market maker wins on his stock, then the person that sold the stock, they're losing. So, if you go a couple of steps, you can get it to zero sum. But on their surface, I would say that the way most people think about it in just the market maker versus customer aspect, they are not. That would be my general take. And I would also say that the time when they're not a zero sum game is when we have cheaters, like somebody with some, let's say, well-timed flow buys options that have a very low delta that end up becoming wildly in the money. The market makers probably didn't get to hedge that position very well and are probably losing big.
I was going to say,
something like
that's
that.
when it is a zero-sum game. I've been run over on those a few times. I didn't get any stock against that.
So so the answer is no, they are not a zero-sum game, with a caveat that, yes, they also are a zero-sum game.
When you get run over by Goldman at 259, buying 100,000 of whatever out of the money calls, and you have no chance to get the stock before the close, and of course they upgrade it right after. Yeah, that's when it's totally zero-sum. I see you there. And I can maybe see your point. It's a bit stretching it, I'll give you. But yeah, the specialist, if you rope him in, the guy who sold you the stock, then yeah, he's losing. Which gets back to my original.
You've got to take a few steps, but like I said, at their surface, on a normal fair trade, they're not zero sum. But if you take enough steps, or you've got a cheater, they become zero sum.
And we can all agree here, right, that Delta One stock is a zero sum game, correct?
Yeah, I would say so.
I don't see how it's not. I had a long argument with Dan to this effect for half an hour yesterday. I still don't see what he was trying to say. But this clearly triggered a lot of our audience. People sent in epic treatises with why I haven't had a chance to read them. I don't have that time yet. I'll have to devote half an hour after the show to these. But people are clearly triggered on this issue, which is, go figure. It's always interesting what sets off the audience. We did a thing on box spreads like a year ago, and people loved it, and they went crazy, and they got all fired up. On box spreads, the most innocuous of things. And now here we are, something seemingly innocuous as well, the notion, are options or are they not a zero-sum game? Just really, really triggering a lot of people, which is crazy. Mr. Flowmaster, as the man who analyzes the flow all day long, you'll get the final word on this. First off, stock, zero sum, yes or no? I think I know which way you're going on that. And then B, the options, where do you fall on that one, sir?
I do believe that stock and futures too are zero sum. There's a buyer, there's a seller. I guess you could kind of get into some sort of argument about opportunity or something like that. But with options, I think Mark and Mike are both correct. It's not a zero sum game. Really, as soon as you really start to think about how does this work, and the reason this market is so successful is that in every trade, basically there are, it's favorable, it's desirable by both sides, right? So, if option buyers were just losing money, then there wouldn't really be any more option buyers. And when you go down a level or two, like Mark said, it becomes very clear, like, oh yeah, you're getting convexity, which means that basically you have the opportunity to capture, P&L through gamma. And that's kind of the piece where, I can buy a call, and you can be the seller and we can both make money on the trade. And so it can't possibly be zero sum because we both made money on the trade. And that tends to be the level, the equilibrium of these prices is we both want to do that trade for a reason. So definitely not a zero sum game, but I think it's our responsibility to try to educate the world and get people to understand how could I buy this option for $1 and in the end it expired worthless and I held it to expiration. But I didn't lose any money because of the activity that I was, the reason that I bought the call and how I was kind of hedging it over time.
Just scrolling through some of the many epic responses we got. This one guy gets it just for the handle of the week, bleeds. But he agrees with you, Mr. Meatball. After a very epic treatise, he says if you include the hidden guy that sold the deltas to the market maker, then it's not. So that's exactly what you were saying too. So you got to go multiple steps, probably beyond all rationalization to include that. But okay, maybe I could be open to that somewhat crazy caveat. But in the real world, the way options are practically traded and hedged in the real world, they are not a zero-sum game. And I will fight you if you say they are. I'm just kidding. We love all of our listeners, even the ones who vehemently disagree on seemingly innocuous things. We love you all. As long as you're listening, hey, if you're inspired to write in, then by all means have at it as we go around the block. All right, well, I go deep into this epic list of responses to the notion of our options, a zero-sum game. Let's go around the horn. Man, you never know. You never know what's going to trigger people, listeners, which, again, makes it fun at the end of it. We love you all out there. Let's go around the horn, see what everyone's keeping an eye on for the rest of the week. We'll start with the Uncle list of Mikes. Mr. Uncle Mike, sir, hopefully I haven't triggered you with this question. And B, what are you keeping an eye on until the Monday episode?
Well, here's what you did trigger me on. Can stocks be a zero-sum game? Yes, they can be if you involve options. So I guess that's kind of what I just thought of as we're going through this. So stocks could be a zero-sum game if options are involved too.
You mean they could not
that makes options zero-sum game, and so we just keep going around the circle with this, I guess.
I did think about that. I was like, what if the specialist is using options to hedge? Then we're getting into all sorts of crazy, mad iterations that really aren't that practical or viable. But I did think about that down the rabbit hole. What if the stock specialist is going the other way and hedging with the options? But that's a conversation for another day, sir.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, let's get to it. A little bit of Options 101, a little bit of a different topic here today, Mr. Matt. We're not going to go over what is a credit spread or anything like that like we normally do, but something that we found to be surprisingly controversial. It's always the seemingly banal things that sneak up on you and somehow really resonate with the audience, trigger a lot of people to comment on both sides of the issue. I remember we did an episode on box spreads a few years ago, and I had a similarly contentious reaction. I was surprised. It's box spreads, the most boring thing on the planet, an interest rate play. And when we debated this last week on our Options Bootcamp show, Mr. Matt, myself, and Mr. Dan, I thought we would have a similar reaction, very kind of open and shut conversation. But no, this actually opened the door to a lot of interesting debate, a lot of feedback from the audience on both sides. Also a surprisingly contentious question of the week. What the heck am I talking about? What is this hot button topic? Is it selling zero DTE premium? Is it something else? Is it inverse vol? Something completely and totally contentious and volatile? No. It is the seemingly simple notion, are options at the end of the day a zero-sum game? And we brought this up because we used to hear this all the time back when we were market makers. We used to chuckle. Options are a zero-sum game. It has to be a winner and a loser on every trade and a buyer for every seller and vice versa. And we kind of laugh because technically the latter portion is true, that of course there is a buyer for every seller. But again, there is clearing in between. There's a market maker there, and they don't really have the same opposite economic intent that you do. They're playing a very different game. And then also, as market makers, as we all knew, we were hedging away the delta risk almost instantly on most of these trades. So we were playing, again, a very different game, a more vol and skew oriented game than the end retail customer was, which is usually very delta oriented. So we used to laugh because there are many examples. I'll just give you one, listeners, of where both sides of an options trade can win. For example, you are, let's say, Apple. Apple is trading around 170 right now. Let's say you're bullish in the next month. You think it's going to blow through 180. So you buy the 180 call for, let's say, $1. Let's say it's just straight customer to customer. Let's even forget the market maker side of this for a second. Let's say you're a customer, you're long some Apple stock, and you think, you know what, I wouldn't mind letting my stock go. It's been a good run at 180. I'll collect $1 for that, so I will sell that call to you. So now you have two sides of that trade. Now let's say the Apple closes 183, somewhere 185, somewhere in that range, north of 181, obviously. Now you might say, well, the guy who sold that call loses. But no, of course, he has stock in his back pocket. So he ended up letting that stock that was trading around 170 go at effectively 181. So he wins. He's a happy camper. And guess what? The person who bought that call for $1, they also win. They made $2, $3, $4, $5, somewhere in that range, wherever it closed above 181. And so they both win. That's the same thing with market makers. They have the other side that they're hedging all the time. So there are many examples where they both win, or sometimes they can both lose on a trade. But the notion that options are a zero-sum game seemed to me to be demonstrably false, but it kind of kicked off this hornet's nest, Matt. That's been kind of fascinating to watch. We got a lot of epic responses from our listeners on both sides. We'll get into it in more detail tomorrow on Options Bootcamp, because that's where this debate kicked off. But I wanted to give you a chance to weigh in on this as well, Matt, including, we put this out to our audience, a very simple question. Are options a zero-sum game, yes or no? I thought it would be overwhelmingly no, 99.1%. And no, it ended up coming out pretty close to 50-50, Mr. Matt. 57.4% saying no, 42.6% saying yes. So clearly I underestimated the contentious nature of this seemingly simple question. So first off, where do you fall in this debate? Are options a zero-sum game, and why, sir?
Well, I like to see both sides and argue both sides and then pick the best one. So I think the people that say yes are just saying, well, their options are contracts. For these contracts, there's a buyer and a seller. So clearly that's a zero-sum game there. So that's they're kind of actually technically zero-sum. But, I fall on the no, because especially in equity options, as you say, what people are trying to do, I think out there, and why options are so successful, because you have an equity market that has a risk profile, and as you see, a payout picture for a stock is just from the bottom left-hand corner to the top right-hand corner of a chart, and options can give you a more tailored risk payoff. And that risk-adjusted returns is really what all investors should be looking at. And so options play a very important role, not just in helping you tailor your payoff picture or your risk, but there's also a ton of information in there that is important for valuation of companies. Now, the embedded option is now extremely important in finance, and that's my background is finance since undergraduate, graduate school, and obviously as an option market maker. And so options are extremely important, and not just kind of written off as a zero-sum game. I could move on. If you do that, you do it to your peril, because there are certainly a ton of opportunities to profit in the option market, but mostly to manage your risk, and mostly to understand the financial nature of options and valuation and the embedded options and so many things out there, not just economic. And that's why I think it's important for the zero DTE, and where I think it's going to go down to hourly, is seeing the risk and what is going on, the implied moves in the market, is important for the entire investment public. So that's where I'd say no to that, Mark.